welcome all to the first of our joint Cobalt Blue Holdings Row Motion webinars. Let me introduce to you today's panel. I'm Joe Kadravic, the CEO of Cobalt Blue. I'll be moderating the panel, and on the panel today we have our own Joel Crane, COB's Investor Relations Manager, and Row Motion's Managing Director, Adam Panay. The webinar format is 45 minutes or so in total, though we can go over if the Q&A gets interesting. And Joel and Adam will both start with individual presentations, which will then conclude in Q&A. During the webinar, all audio-visual will be disabled for attendees. And if you wish to ask a question, on the bottom toolbar of the software, you'll see a Q&A function. Please click on it, type in your question and click send. I'll moderate the questions and then distribute them between the panelists. At the end of the webinar, we'll display our contact details. You're very welcome to email further questions, and we welcome those, and we can answer those in the coming days. Having said that, that's it. Let me hand over to Joel to kick off.
Thank you, Joe, and thanks for everyone who's joined us today. Look, we're really pleased to provide the opportunity to share what Cobalt Blue is observing in the market, but also to offer the floor to one of our favorite analyst groups, Row Motion, who specialize in EV and battery markets. So thanks again, Adam, for joining us. It's a real honor. So I'm going to start with some comments around current and future cobalt pricing, but also give some thoughts around what we believe is the most important developments so far this year. For us, it's the global movement to accelerate the production and processing of critical minerals. It's just a few brief comments on cobalt as a commodity and the pricing around it, simply because that chart you can see of cobalt metal and intermediate and sulfate prices looks fairly similar to a number of other commodity charts we're seeing at the moment. Cobalt itself, at least the metal, is down about 30% from the mid-second quarter peak and is now under $30 per pound for the first time since last November. We do note that the LME price has been even more volatile with some pretty sharp declines in recent days. But look, we don't really consider the LME price as an accurate snapshot of the cobalt market itself. It's very thinly traded with monthly volumes below 1% of global demand. So we ourselves, and we encourage others to follow the various PRAs, such as Fast Markets and Platts, that track daily transactions between producers and consumers as a more accurate depiction of what's actually happening in the cobalt price. So a few factors behind falling prices of cobalt specific. Like many commodities, the lockdowns in China really impacted all sorts of industrial activity, including battery production. So that basically just slowed the purchasing of cobalt. And interesting stats now out for China, metal demand growth in the first half of the year was negative for the first time in a very long time. So this, of course, impacts all industrial commodities, but also obviously the concerns over impending inflation-driven recession. And this is a developing narrative, obviously, around the Fed and what's going to happen with U.S. interest rates. And this pushes the U.S. dollar higher, which is always a headwind for commodities. Also in cobalt specifically, there's some weakness in the 3C sector, computing, communication, and consumer, again, wrapped around the recessionary concerns. And we're also hearing from the market that there is tightness in other battery materials, intermediate markets in particular, such as lithium and nickel hydroxide. And this is driving battery makers to the recycle market, where there's a bit more material available. And obviously that just drives them away from purchasing primary material. But despite this broad market pullback that we're seeing across all sorts of assets, we do expect EV-related commodity exposure to rebound as numerous supportive demand and supply fundamentals remain intact. Adam will touch on some of the demand side of this, but really, I mean, we can point to all sorts of stats like EV sales and charging pile installations in China are still ripping. And on the supply side, there is a temporary suspension of exports at China Moly's Tenke Fungi copper and cobalt mine. That only highlights the difficulties in that part of the world. So for us, on a longer term view, the cobalt market looks very structurally strong, with healthy demand growth likely to outstrip that of supply, and that should keep prices elevated well above the long-term average of $27. Moving on to some industry trends, like I said at the beginning, we think some of the most important developments over the past several months have been the growing movement from governments to support the development and acceleration of the critical mineral sector. There's just simply lots of money being thrown around to get the ex-China industry up and running. This is, of course, very fortunate timing for us and our peers, as this support from government, both domestic and external governments, has never been stronger. looking specifically at bilateral agreements over the past 1 or 2 years, numerous of these agreements have been established as countries realize they simply can't build out purely domestic supply chains large enough to meet demand and therefore require cooperation from partner countries. The Cobalt Blue executive team was fortunate enough to be invited along for a 4-day delegation to Washington, D.C. earlier this year, when the then Trade Minister of Australia and U.S. Commerce Secretary discussed cooperation between Australia and the U.S. And since then, the U.S. government has doled out 2 loans to ASX-listed resource companies worth about $230 million. So these aren't just plans that are being discussed, it's actually happening. And of course, countries are spending a lot of time and effort investing and trying to support their domestic industries and just try and get as many projects up and running as possible. We've been fortunate enough to be on the receiving end of that type of support. This year, we were awarded major project status. We were also awarded a grant as part of the Critical Minerals Accelerator Initiative of $15 million that's helping bolster our DFS. There's likely to be more money coming. We noted in the New South Wales budget announcement a couple of weeks ago, they indicated there's about $200 million in potential grant money for the sector. And look, the change in government here in Australia has not slowed progress. In fact, we're feeling more acceleration in these type of support programs. And finally, we've seen a lot of government support investment in the downstream. Governments are very supportive of that part of the battery supply chain, given the concentration of that at the moment in China. Just taking cobalt, for example, which this chart shows, is there's very little sulfate refining capacity outside of China, but that's going to change. You see all sorts of announcements. Last week, Umicore announced $1.5 billion battery facility in Ontario. In Europe, Norvolt got a 1.8 billion euro grant for its electric storage system plant in Poland. And back here in Australia, last week, the Future Batteries industry in WA launched a pilot plant to produce cathode precursors using 100% Australian materials. We're proud to be the C in the NCM chemistries for that plant. And we believe that once our project is up and running and our facilities are there, we're going to help lift Australia onto that chart, hopefully help Australia become a powerhouse in the downstream industry of battery production. Look, I'm going to leave my comments there. I'm happy to discuss this in the Q&A session or any other questions you might have about the cobalt market or COB itself. And with that, I'll hand over to Adam to give us a run through of what he's seeing on the demand side.
Thanks, Joel. And thanks to Cobalt Blue for having me on as well. It's a pleasure to be speaking to you today. So I'll be talking about the demand side of this market. Because we're talking to a cobalt-facing audience, we're going to keep this really on the EV part of the market for battery demand. But if we just kick off now into the first slide, we can see the rate of growth that we're expecting for this year in terms of EV sales. 2 charts here. The one on the left-hand side is the EV penetration rate as a percentage of total vehicle sales in a selected number of markets, but these are the ones that are really developing quickest. What you can see there, the purple bit on the top of each bar, is the growth this year versus last year. So even with 2021 and 2020 being very strong years in Europe particularly, we're still seeing growth into 2022 despite some of the headwinds we're seeing this year. Where you do see it going down, it's really because the market has been affected by various supply side issues, which I'll come to in a moment. On the right hand side, you see our forecast for this year, our near-term forecast, with a shaded area for the year to date. That was to the first quarter. And what you can see here is actually we're expecting 10.3 million vehicles this year, which is growth of nearly 60%, but it's actually a slight markdown from where we started the year. Most analysts were saying around 10.8 to 11 point something, early 11s millions units. But on the supply side this year, as I mentioned, there's been some real significant headwinds that have forced us to dial that back. So if we maybe go to the next slide, what you can see here is we've just created this image which just talks about very, very near-term tailwinds and headwinds for this market. What I would say is that the tailwinds tend to be structural in that they are long-term and they're legislative and they are almost like a decade-long tailwind, but the headwinds tend to be shorter-term. We've had this year a land war in Europe, which was really not foreseen by most spectators, I would have thought, prior to it happening. We've had another lockdown in China, which again was somewhat unexpected. Also, you have this inflationary pressure that Joel mentioned as well, which is creating difficulties in lots of different ways, not least in that it might feed through to, or is feeding through to, higher interest rates, and it would be interesting to see what the impact on consumer demand is there. But the key things that are really affecting the market this year from an EV point of view are the ongoing semiconductor shortages, which again, that's been in the pipe now for a couple of years because of what happened during COVID, in that the automotive market effectively pulled out of the semiconductor market. A lot of that material went over to consumer electronics and hasn't come back to automotive. That will start to ease over time. What we're starting to see now is actually that as interest rates go up, consumer demand for portable electronics is starting to wane, and that is probably going to free up some semiconductor availability for the electric vehicle market. Vehicles actually need fairly basic semiconductors, much more basic than you need for high-end consumer electronics. The potential for that to ease up fairly quickly is pretty good. But that's going to be an issue this entire year and into next year. But then back end of 2023, we should start to see that ease off. The COVID piece of this really is obviously the initial impact on supply chains, but what's been happening in China in terms of lockdowns, particularly in Shanghai, where there's a lot of vehicle manufacturing activity, especially around its periphery. That again now is pretty much eased off, but the impact of that will be felt as it works its way through this year. Again, it hits supply chains. There's some catching up to do in terms of production, and that's part of the reason why we downgraded our forecast for this year, but still to that very high growth piece. We obviously have this issue around raw material prices. Again, as the chart showed for cobalt sulfate that was shown just a moment ago, you start to see some of that pressure ease. Not so much for lithium, but on some of the other materials, started to back off. But again, raw material prices remain relatively high compared to previous years, and that's feeding through to some of the vehicle prices. Nickel has been an issue this year. Clearly, Russia is a very large producer of nickel. That the uncertainty around that, really, rather than anything direct, has had a knock-on effect on the price there, which has caused some issues. And a key one in Europe, actually, directly attributable to the Ukraine conflict, is the wire harness situation. Now, again, this is eased off, but it has affected the numbers for this year. Ukraine is a large supplier of wire harnesses for vehicle production, particularly in Germany. Volkswagen was quite badly hit by this. This is the economy now for armed conflict. And that really did impact European vehicle production, particularly in Q1 and Q2 of this year. Now, one that's interesting, actually, is the Chinese subsidy cut. As it stands, the Chinese government is planning to roll out subsidies get rid of them by the end of this year. There have been noises that might be extended into next year or beyond because of some of these issues that we've seen this year. The key thing for this is that they've been reducing that subsidy for years now, from a very, very generous one several years ago, and it's came down in 2019, notably into 2020, into 2021 as well. Hasn't really affected demand in any way, shape or form. In China, you have the most significant number of models you can buy. You can go out and spend $5,000 on an EV, or you can go out and spend $100,000 on an EV. And the market there is maturing, I would say. So the subsidy is less and less important each year in terms of developing the market. Now, think about the tailwinds. As I mentioned earlier, these are much more long term. So the key one, really, and the one that we started the business on and we think is crucial to understanding this market long term, is emissions legislation. Emissions legislation comes in two forms, primarily. The first is on CO2, which I'll come to in a moment, and the second is on air quality, nitrous oxide and particulate matter. On both fronts, the European Commission really drives the world forward on this. And on both fronts, the European Commission is tightening that legislation as we speak. So on the air quality piece, the current regulation is Euro 6. There is Euro 7 legislation being developed. That will make this market even more difficult for internal combustion engine vehicles to survive, particularly for diesels. Not because the technology isn't there, but it just makes those vehicles incrementally more expensive as the legislation gets tighter, because you need more catalysts, you need more filtration and so on. On the CO2 side, we currently stand at 95 grams per kilometre as a fleet average CO2 target in the European Union. Equivalent targets will be rolled out around the rest of the world over time. Now, OEMs are struggling to get to that number already. They have introduced BEVs into their mix in a greater way in the last couple of years. And if you want to understand why Europe has picked up so much in the last couple of years, because that target came in. That has a step change over the next couple of years in order to tighten that. So we have a 58 gram target coming in the next couple of years, and then it goes down from there. But what has been passing through the European Commission and European Parliament in the last couple of months is a ruling which would take that emissions target down by 2035 to the extent that you would effectively ban internal combustion engine vehicles. Germany, for obvious reasons, have been resisting that. They've got industry to protect. Some of the larger vehicle manufacturing countries had also been resisting that. Germany have now removed their opposition to this ruling, and so it looks now it will be confirmed into law pretty soon. So that does mean that by 2035, in theory, you have a zero ICE market in Europe. The reason I say in theory is because within this legislation, there's always wiggle room, there's mitigations, is a stakeholder-driven development. But it means by 2040 and into the 2040s, realistically, then you'll start to see the full phase out of plug-in hybrids, hybrid electric vehicles, and ICE vehicles, and you're going to be left with BEV only. As it stands at the moment, just on that, OEMs make their money by selling large SUV ICE vehicles. And the only way that they can continue to do that in the coming years is by selling BEVs in order to bring down their fleet average emissions at a portfolio level to the current targets. The other things that you're seeing that are really developing the market in a structural way and over the longer term is this greater availability of EV models. As I mentioned, in China, you can go out and spend $5,000, you can go out and spend $100,000. In Europe, that's not the case, or North America, it's much more at the top end of the market. That's where the demographic is that's buying these vehicles, but that's changing over time. And if you take this year, the Ford F-150 Lightning is coming into the market at $40,000 for the base model. That's an incredibly competitive vehicle against its even against its ICE namesake. And there are other things coming through as well. Consumers are starting to accept this in a larger way. And also we're seeing the charging infrastructure, which was something we were really worried about last year. The investments are coming through. It is starting to improve significantly as we move on. So with that, we'll go on to the next slide. So moving away from, say, the EV market and moving more towards thinking about the battery demand and how that looks from a chemistry point of view. This is just for the EV market in terms of the split of chemistries. What you can see, it's effectively year-to-date, on the right-hand side, the bar charts are year-to-date splits of chemistries by LFP, NCA, which is effectively the Tesla chemistry in the US, and NCM. In our work, we break down the NCM into 111, 523, 811, etc. But just for the point of ease, this is a much better way to compare it. We'll think about these trends on a macro level. Now, you have to take into account the fact that LFP has come back somewhat in the last couple of years. So if you'd been speaking at something like this in 2018, you would say that LFP was a dying technology and NCM was going to take over the world. But what we've seen is that there are so many supply side constraints on the key raw materials for NCM, and that isn't so much the case for LFP, that we have seen LFP come back, and it has been improved as a chemistry effectively at a systems level. And what I mean by that is in the vehicle, you are looking at, because it needs less thermal management and so on, you're looking at ways within the vehicle to make it more efficient in terms of its deployment. What I would say, though, is if you take like for like LFP versus NCM, it's still massively down the chart in terms of energy density. Your current NCM batteries are something like 280 watt-hours per kilogram on a gravimetric basis. LFP at cell level is still under 200. At systems level, there is some degree of parity, moving towards some degree of parity, but NCM is by far the more efficient deployment of batteries for long-range vehicles. Now, the thing you need to bear in mind here is that the market, even the internal combustion engine vehicle market in the US and in Europe now is moving towards larger vehicles. So when you think about this trend longer term, LFP will have a role. I'm not going to deny that. But from the point of view of cobalt demand and where that goes in the future, NCM is still going to be a very dominant technology in this market. And the reality is, this isn't a zero-sum game. We need both technologies in the market in order to enable the rollout of these vehicles longer term. So LFP will be at the smaller portion of the market, and maybe some of the mid-size. For performance vehicles, for larger vehicles, which is the way the market is going in Europe and North America, you are going to need NCM in there. And as a result of that, you're going to need Cobalt. We can get into that discussion in maybe a bit more nuance in the Q&A. It is something you get asked a lot about, but people tend to have very, I'd say, overly dramatic responses to technology changes in this market. NCM is going to be around for a very long time in this market. Looking at the left-hand side of the slides, you see splits of demand by region. for 2020. Actually, the dates got wiped off that, but that's for 2022, and then for 2025. See that China remains the dominant market over time, but Europe and North America start to take a larger share over that. And again, just think about that then in terms of what that means for demand from a chemistry point of view. This just actually sums up some of the thinking. This is quite a crude analysis. We do this in a lot more detail in our reports, but just for the point of view of just expressing how the chemistry deployment gets put through. Effectively over time, you're going to have three main technology areas on the cathode side: LFP, NM, so nickel manganese, and then NCM/NCA. And again, this just really lays out in a very crude way what each OEM or the major OEM group's plans are for their large, medium, and small vehicles. For the smaller part of the market, like I said, it is going to be LFP most likely, although there are some question marks around that in Europe now, but we can come to that in the Q&A perhaps. Medium size of the market will be NCM, LFP, and NM, I would say. And then the large part of the market, it will be in cobalt bearing NCM type technologies. And then on to my final slide. Okay, so what this shows you is just the development of terawatt-hour deployment for the EV market over time. No surprise to show you that it goes up very, very quickly based on all the things I've just said about the structural developments pushing this market forward. But what's quite interesting as well is the share there of NCM to LFP and also the nickel manganese technologies as well, which are the light blue period there. So what you see here is actually the relative shares of these technologies stays relatively stable. There are a few other things to bear in mind as well, that if you think about this deployment at a chemistry level, you need to think about battery pack size. And NCM is going into larger packs. So it might be 80 kilowatt hour packs, 90 kilowatt hour packs. The average for LFP at the moment is down around 30. So you've got to sell 3 LFP bearing vehicles to get you to 1 kilowatt hour equivalent of NCM bearing vehicles. So it's just, again, something to bear in mind. It just gives you some idea of the direction of travel. Like I said, this is not a zero-sum game, and there will be multiple technologies playing in this market for the foreseeable future. And with that, I hand back to Joel and Joe.
Thank you, Adam. Excellent. Thank you, gentlemen. That's a very good summary to date. We've got a number of questions. I might hand over to Joel in the first place. There's a question here. Joel, can you comment on any forthcoming regulations in the EU with relation to sourcing cobalt globally from jurisdictions such as DRC, Indonesia, etc.? What are you seeing there?
Yeah, I mean, that's a question we get quite a bit, so thanks for that. Look, I don't think there's going to be any very specific regulations against jurisdictions, particularly the ones that were specified there, DRC and Indonesia, simply because in the cobalt space, that material has to be required. What I think is going to drive the change and the move towards more ethically driven material is actually going to be done on the auto and battery maker side, and that's what we see in here when we're in discussions with commercial partners, particularly in Europe, is that the race is on to secure materials that are deemed more ethically or ESG responsible. It'll be driven by those actual consumers, and we see that all the time. That's some of the first questions we get are, can you please run us through your climate policy or your carbon policy? But this is all because these are the mandates that they've been given, the procurement teams, and so they'll be looking for that ethical material. And like I said, the race is on. Who can secure that first? Otherwise, you're going to be forced to the more traditional parts of the market.
Thank you, Joel. Adam, perhaps one for you. The question is, does the current charging infrastructure within the EU and US, is it enough to service future demand? Is there a pinch point there?
It's not enough to service future demand, but by the time that we get to the future demand point, it should be ready. As I mentioned, last year and 2020, we were fairly concerned about how quickly the EV market was developing versus the charging market. The rollout of charging infrastructure is actually relatively difficult. You've got to dig up a lot of ground, infrastructure and grid issues to put into play. But our sense is that charging won't be a constraint on EV demand. At the moment, what you're seeing is that most, particularly in the Western world, most of the EV charging is happening at home. I mean, we're talking like into the 90%. That will remain the case for the foreseeable future. What happens when you have a demographic shift towards the lower end of the market, where you're less likely to have people with single family households or driveways and that sort of thing? then you are going to need to see a much more comprehensive rollout. But by that time, given what we're seeing in terms of the funding and some of these infrastructure rollouts, that shouldn't be a problem now. Again, like I said, if you'd asked me 2 years ago, I would have given you a slightly different answer, but the market does seem to have woken up to that.
Thank you. There's a follow-up question here, which is related, so I'll just go straight back to you. And this is, I think, an Australian context question. Can the grid service EV charging? There's a perception that there's not enough latent generation capacity and the EVs coming online will cause grid stability issues. Can you comment from a global perspective how that's been tackled?
Yeah, and again, you need to see this on a slightly longer term basis. So at the moment, I don't think there's an issue given the level of consumption you're seeing from electric vehicles into the, given the level of market development we have at the moment. When you're talking about a saturated market, let's say 2040 and thereabouts, then yeah, if nothing changes on the grid level, there can be issues. But yeah, you've got nearly a 20-year headroom there to do something about that, and those infrastructure developments are taking place. A key one actually is on the battery side, for example, is that we're seeing lithium-ion batteries being rolled out into grid stabilization. So you're having energy storage put a battery solving a battery problem almost on the grid to try and even out some of the peaks and troughs there. Other things that are coming through as well, again, that if you'd asked me about 2 years ago, I would have been slightly more skeptical about vehicle to grid. That does look like it's going to be developed over the next decade. And for the time span we're talking about where it's going to be, infrastructure is going to be put under pressure, there are solutions in the pipeline that are going to come to the fore. I don't really see that many issues from that, to be honest.
All right. Thank you, Adam. Joel, one back to you, a good shareholder question. What are the major expected catalysts for the company over the next 6 months?
Well, for us, the most important thing that we've got is putting together the demonstration plant. All the pieces have now been delivered, and the plant should be commissioning by next week. So what we've done is put together some mining in the asset itself. We've got a 100-meter decline. It's directly into the resource. We're going to pull out around 4,000 tons and process that material into either MHP or cobalt sulfate and send that around to our commercial partners for qualification in much bigger lots than we had sent in the pilot plant last year. That's important for other reasons as well, because the campaigns, we're going to do things like 20-day campaigns and 24/7 shifts, do 3 or 4 of those campaigns, and that will form a major data for our DFS, which is due sometime at the back end of next year. So that's the main catalyst for us, and you'll be seeing increasing amount of news as that demonstration plant operates, and we're able to work out what things are going to look like in the eventual longer term or larger scale project. That's the main one for us, Joe.
Thank you, Joel. So plenty to look forward to, you're saying. Great. All right, next question we have here is, which I might take, is what is the current retracement in the cobalt price? Is it affecting financing for completion of incoming projects? So I just might put my hand up for that. Look, clearly spot has some relevance to all financing decisions, but the predominance of that decision is made on long-term cobalt, $8 and other assumptions, which haven't really changed in the near term. So financing really is beholden to what long-term expectations are all about. Little of that has changed, and what I can say to investors, not just in our project but others, that this near-term retracement is really just noise in negotiation. I've got a question coming back to Adam. He talks about LFP and non-cobalt cathodes. It's really a question about risk, the effects and the risk. What's the risk in the modelling to cobalt in the cathode?
You know, we have seen a trend even with NCM of drifting down the level of cobalt in the battery. You know, started out as equal parts to cobalt manganese several years ago, and now we're at a ratio of maybe 10% cobalt in the cathode, as in China, though, rather than anywhere else. But I would say that, as I pointed out in that chart around OEM decisions, choices for the technologies, it's been very, very difficult for OEMs to move away from cobalt-bearing cathodes in the Western world. In China, they went to NCM 811 quite quickly, and there was a series of fires around that. The first ever vehicle that came out with it in large format was the GAC INS, and they had to do a recall on it, and they went back to insulin 523 afterwards because they've got the things. In the US and Europe, if you look at the OEM plans for what's being rolled out, something like the NCMA battery from GM and with their LG partner, all their batteries for the next 5 to 10 years on the NCM side are cobalt bearing. So I don't really see that there is that much risk. What was a risk to the market prior to LFP coming back and some of these nickel manganese technologies coming through is that there simply wouldn't be enough cobalt to supply the market, and that could have put a brake on demand. And then once you start to put a brake on demand, then you start to question the long-term viability of the market. So, as I've said, and we've been saying for several years now, is that the market needs diversity in terms of the technologies available for different applications. And NCM is going to play its role, and Cobalt's going to play its role in that.
Okay, thank you. And one straight back to you again, Adam. Can EV sales stand up without subsidies? What's the non-China experience there?
Yes, a good question. My sense is that it depends what you mean by subsidy. I know that's a bit of a cop-out, but direct cash subsidies, yes, I think they can in the next couple of years. But what you're seeing somewhere like the UK or in many other parts of the world is tax incentives for things like leasing. So take the German market, company vehicle lease, they lease vehicles from OEMs for their company cars. That's a big part of the market. The fleet part of the market is a big part of the market. So tax incentives and those sorts of things are driving some of the move towards EV. Ultimately, what will happen is that the vehicle range will become much greater and the price points will become much greater, and then subsidies won't be, or incentives won't be such a big part of the market. Like as I mentioned in China, they're really becoming less and less important month by month, frankly, as the vehicle range becomes greater. But yeah, it would be inaccurate to say they're not part of the market in the European and US experience, but give it 5 years and I don't think that's going to be such a problem. But one point I'd like to make, if you don't mind, is that people talk a lot about battery prices and how that affects the ultimate vehicle price. Now, it does at the moment because the battery takes up quite a big part of the overall vehicle price. But as we start to see pure EV platforms rolled out, which is starting to happen already, something like the ID3 and on the MEB platform, for example, as that becomes more ubiquitous and happens more and more at scale, the overall cost of those vehicles will start to go down as well. Because when we do our analysis, the thing that needs to be driven down in terms, and can be driven down in terms of scale, is on the platform level. EVs are relatively simple vehicles compared to ICE vehicles, and you'll start to see parity anyway, regardless of subsidies. Previously we would have said around 2024, 2025, because of some of these price increases over the last couple of years, more like 26, 27. But the market will start to stand on its own 2 feet before the end of this decade.
Thank you. Joel, one back to you. The question here about the impact of the China molding mine, I assume that's 10K. What's the impact of the mine closure going to have on the market, and how long will the shutdown be, in your opinion?
Yeah, obviously a difficult timing to forecast. Typically, these type of disputes between government and private companies don't last terribly long. It's not in anyone's interest to have these facilities shut down from an employment standpoint and obviously from a revenue standpoint. But 10K is very large. It's about 10% of the global cobalt market. So should it stay shut longer than a couple of weeks, I think the market will start to react. At the moment, simply because of the sharp drop in prices, there's plenty of inventory around because consumers tend not to purchase during times of sharp price fall because they don't want to get stuck with material that maybe is 5-10% above where the price eventually settles at. So we do have several weeks, I would say, of inventory to chew through before you start seeing a major price reaction. So I'd probably put that number on 2 to 3 weeks before you start seeing a price reaction, but I would expect that before that time there'll be some sort of resolution and a return to exports from that facility.
Thank you, Joel. Back to you, Adam. What percentage of EV owners charge at home or at charging station? And is home charging viable for apartment owners in high density dwellings? It's just an extension of your earlier.
Yeah, so just to come back to, in terms of kilowatts or kilowatt hours deployed, it's over 90% is deployed at home now. This is, as a global average, I'd say that's fair. What I would like to do is maybe give you a bit of a case study in different markets, because this is all driven by demographics, and the question hints at that. If you look at Norway, which is the country with the highest rate of EV penetration anywhere in the world. It's into the 70s. I mean, it's incredible the rate of development there. Has actually one of the worst ratios of public chargers, fast public chargers to EVs anywhere in the world. It's something like 26 public chargers to EVs in the world. Hasn't inhibited the market there at all, because the demographics tell you it's a suburban market, very low population density in that country, very high level of families living in single family households with driveways. Take China, which is the largest market by volume in terms of number of vehicles sold, quite the opposite. China at a national level has quite low population density, but in terms of where people live, it's very high. In urban areas, it's very high. So China has one of the best ratios of public chargers to EVs because there's a business case for it there. So these things do tend to take care of themselves. I mean, so yeah, charging at home is not viable for high density households. New apartment buildings are all being built with EV chargers in them. It's another revenue stream for whoever wants to take that on. But it's someone like China, right, the government got behind it, but you have the mitigation at the public level. So the point is there's no one answer here. And if you look at different markets, they're going to behave in very different ways.
Thank you, Adam. I'll take the next question myself. The question is, the smaller Cobalt samples were sent to partners some months ago. Was there any negative feedback? Well, the first samples we sent from the pilot were about a year ago. We sent two classes of Cobalt product, the intermediate MHP and then the battery, the precursor ready sulfates. The MHPs were very sellable, and the simple reason for that is they are a to be refined product. So there wasn't any hurdles in selling that or marketing that product. And the sulfates, we reported on that to the market. There are individual precursor partners who want slightly different nuances in their trace metal assays, but overall, it's just a matter of us picking and choosing our targets. So really, if we want to sell to a particular market, do we tweak those trace elements to make that market and maybe claim the margin? So yes, we got some very good intel, and yes, we have a strong database of the market, but we're very confident that we can make the right spec of product. Next question, Adam, I'll put to you, and just bear with me. Are any car makers actively marketing EVs on the basis of the battery technology? And if not, why do you think that is? And it doesn't infer that the consumer doesn't care what's under the hood.
Yeah, in terms of the split between LFP or NCM in that sense. Yeah, it would take, I'd say, take a fairly sophisticated car buyer at this point in time where we are in the market to understand the key difference. What are being marketed is different ranges, and some people may understand that, you know, for the standard range Tesla Model 3, that's now LFP most part. You know, some buyers might understand that. I would imagine that most OEMs don't make those sorts of noises in public. I mean, from our point of view, you know, when we're having conversations with them, yeah, we will talk about the vehicles in these terms, but you know, there's quite a big difference between the consumer and specialised people that are in this market. So I don't really think that's an issue. I'd be, you know, curious to see how that pans out over the years. But what you will see, something like the Ultium battery, for example, the GM LG Chem tie-up, that's probably how the brand is going to happen. You're going to get, you know, ideas about performance from a battery without necessarily people understanding the chemistry of it. I think is really what will happen. So, you know, there is a reason why they branded it Ultium as opposed to NCMA, for example.
I've got one here. Could you explain repurposing of batteries and its effect on market forecasts?
Yeah, it's a good question. There's a big question around this. Who's going to be responsible for batteries at the end of life, and what you do with them? Okay, so every indication is that from the EV market, OEMs are going to end up being responsible. The law isn't actually quite there yet, but the indications are that OEMs are going to be responsible. In fact, they're behaving like they're going to be responsible. So suggests that they think that's coming as well. A couple of things that says to you. One is, as that conversation has developed, we've heard European OEMs saying, well, LFP is actually quite difficult to make an economic case for recycling LFP at end of life. So maybe they restrict their exposure to LFP. There's been one comment that's come up. Another is, okay, are they going to be able to make money back off these batteries at the end of life? So there's two ways you can do that: recycling the material, getting it out, sending it back into the market for cathode manufacturing and to a lesser extent anode. Or do you sell it into ESS applications, stationary storage applications? Really, it's going to depend on where raw material prices are. There's going to be some degree of arbitrage here in terms of where and how those batteries get treated. And in an environment like we've seen today, even, you know, you showed that cobalt prices going down, but I mean, we're still at a relatively high price environment. the indications are we'll get recycling will come to the fore. There are issues around second life deployment. I'm not saying it won't happen, but there are issues around insurance. You take a battery that is configured to operate in a certain type of use case in a vehicle in certain temperature ranges and so on, put it into another one in electronic stationary storage, energy stationary storage. That's quite a different use case, and you don't know how the battery is going to behave. So there are limitations on how much the deployment of these redeployment of these batteries takes place. In terms of our assumptions, really, again, it is scratching the surface in terms of battery demand longer term. And also, you've got to think about when these volumes are going to start coming through. You're only starting to see really mass volumes of EVs being sold last year and this. Those vehicles are going to be on the road for at least 10 years. And that's when you start to see volumes. But the real great share of batteries coming out of the market from the EV perspective, it starts to happen in the mid-2030s, really. So at that point, the market's probably going to need all the help it can get in terms of saving kilowatt hours somewhere.
Thank you. And I can see Joel nodding furiously in agreement. Joel, some question back to you in terms of secondary sources of cobalt. Any thoughts to add?
Recycling and repurposing of any material is a very important part of the market. You can look at other commodities, lead, well over 50%, copper, 30%, aluminium, 20% is in the recycle market. Cobalt today is around closer to 10%. That's simply just because of the maturity or immaturity of the market versus other commodities. So as Adam just said, and which I wholeheartedly agree with, is that particularly by the 2030s, when we expect demand to be, continue to grow quite strongly at a time when supply is going to be challenged for a number of reasons, that material is going to be required. And I think prices will send that signal to the recycling part of the market, and you'll see a lot of capacity very quickly rolling out. But again, we're at the very beginning stages of the battery life cycle, at least a mass market battery life cycle. So it'll be a while before enough material is going to be there to push that percent of recycled cobalt into the total demand market for a while. So we're probably closer to 2035, 2040 before you get a significant change from that current 10%.
Thank you, Joel. I might grab the next couple myself, their waste streams questions. The question here, is it feasible to extract other minerals from mining waste? We have performed we have exactly 4 test programs to date. We're on our 5th. Yes, we have out of those sulfides extracted other base metals. So typically copper is a co-dependent with cobalt in those minerals. And we've even successfully extracted some gold as well. The question does refer to rare earths. I can't give you a technical opinion because we simply haven't struck it. Not to say that the technology can't be adapted, but certainly there are co-minerals in these waste streams that we're looking at. The other question, which is related, is an update on the tailings project with Oz Minerals. We had, I think it was last year, announced a cooperation with Oz Minerals with respect to Carrapateena. We've gone radio silent on it since, and I have to maintain that radio silence. So there's nothing in the public domain. We remain very focused on waste streams as a second project for us, but you'll have to respect our privacy with respect to that particular negotiation. Adam, one back to you. Any reason to expect differences in battery life across different chemistries that you're seeing?
These days, no. It used to be that, I don't know if people actually know what the role the cobalt is playing in the battery, but it's there for safety on a thermal level, and it's there for life cycle to develop the life of the battery. I would say that, again, a few years ago, that you saw marked differences between low and high cobalt, but thermal management in the vehicle now, system management, means that those batteries are being, there's very little difference between the types of technologies in terms of their long-term life cycle. Again, coming back to that point of end of life value, there is a difference, and there will be a question to answer around the economics of different chemistry recycling, because the owners are going to want to get something back at the end of life, and some technology is going to enable them to do that and some aren't. But at the moment, because of the development of these technologies in terms of really at the system level, there isn't that much daylight now between different chemistries at the moment.
Okay, I've got a question here, which is a generic one, but it's a nice arbitrage, if you like. The question first: what are the key points, Adam, in particular, you're seeing that are misunderstood in the market? What's the messages that you're seeing that the market's simply not getting right?
Yeah, I would say that there's always these slight overreactions to any market news that comes through. So one is on the second generation piece. People talk about, this is probably not really directly related to the cathode side, but it's maybe more on the anode side, but people talk a lot about solid state and silicon dominant coming through and their role in the market and how that's going to affect things in terms of vehicle performance. I would say a lot of that has been overstated. There's still significant technical hurdles to overcome before those technologies come into the market. But that actually speaks as an analog to quite a lot of what happens. So earlier this year, the lithium carbonate price went beyond the lithium hydroxide price for the first time really ever. And started to get a lot of questions, is this the end of LFP? And it's like, well, no, this is not, the market, this is a decade long, if not longer, structural shift, it's actually longer, structural shift in the market, technology shift. These things are going to take a long, long time to come through. People making significant investments in these technologies. And so if you want to know where the market's going, really, in terms of technology development, look at where the billions and billions of dollars are going in terms of the build out of battery capacity around the world. And it's a mix, is the reality. And the forecasts that we're doing are based on what's going to be available, what OEMs are telling us they're going to do. So that overestimating the impact of new technologies into the market, I'd say, is a big thing. The other one would probably relate to the charging side as well, is that the level of investment that's needed in charging, and like I said, now I do think it's coming, is equivalent to the level of investment needed in battery. And I think people don't necessarily understand that. But like I said, there's a very, very clear business case now for charging that never used to be, that will enable that to come. It's actually pretty straightforward. You charge more than the cost of the electricity that you buy in at a wholesale level, and that actually is making those investments very, very easy. And one final one, if you allow me the time, is on the cost piece. Again, for years, people were saying when you get to $100 per kilowatt hour, the battery level, these vehicles be at parity. We would be saying equally for years, that's not the case. If you actually do a breakdown of the vehicle in terms of its cost, the battery is important, but it's not everything. And one of the key parts is at this EV platform level, because that's the bit that the OEM can scale. It's the bit that can some degree of control over at cost level. And that will be the main driver of cost reduction for electric vehicles over time.
Great, thank you. Good answer. Thank you, Adam. And I think in the interest of time, we'll have the same question now as a wrap up for Joel. Joel, you're a senior member of the Cobalt Blue commercial team, so you sit on those commercial negotiations. You see the demand side. You also sit with an IR hat on and understand how investors think about it. What would you say are some of the biggest arbitrages or misperceptions, if you like, between the two?
Oh, yeah, interesting question. Look, I think as a career analyst, it's frustrating to see the market consistently get demand wrong, usually to the downside, and having to play catch up every year, every quarter to try and understand the EV market or the battery market itself. Within that, you get wrapped up in the LFP debate, which we spent a significant amount of time today. And I thank Adam for helping clear up some of those market mysteries. And people think that because LFP has gained market share, that's detrimental to the cobalt price. But I can't agree more with Adam that it's actually healthy because that diversification is required. But also just the fact, even though the pie may be shrinking slightly in terms of market share, the pie is absolutely exploding in terms of demand. So cobalt demand is just going to be phenomenal because of that particular point of just the batteries market themselves growing. I think for me, it's that demand side that I think the market's mostly missing. And then, and sort of as we touched on before, I wouldn't get too hung up on near-term pricing. Like I said, that cobalt chart looks like virtually every other commodity and almost any asset class at the moment price chart. And simply because of the things that we've outlined here, not so much on the supply side, but most on the demand side, the cobalt price is going to remain well supported for quite a while. That's something I think the market gets a little bit too concerned about, is that near-term noise. What we know about how these markets respond to strong supply and demand fundamentals is that prices tend to stay elevated. So those would be my two factors, Joe.
Thank you. So with that, I might call it a day. So a couple of church notices. The presentation that you saw today is now available on the Cobalt Blue website for those who are interested. Let me thank both Adam and Joel for your expert advice. It's always a pleasure to listen to industry experts, and thank you. On behalf of Cobalt Blue, I'm looking forward to an ongoing relationship with RoMotion and keeping in touch with experts like Adam to inform the shareholder and investor base, because I think it's important that those of us in this niche industry of Cobalt communicate as best we can going forward. So I'm looking forward to our next touch points. And with that said, I thank you all, and good evening, good day, good morning, wherever you are. Thank you.